I would say that the Fed's monetary policy will fail or is failing, and fiscal policy will fail, is in the process of failing, even if gold didn't exist. If you didn't have gold as a, multi-millennial monetary standard, even if gold wasn't there as a reference point, which of course it is, but these policies are failing anyway, and there are a lot of reasons for that. Whenever I hear, fiscal stimulus, I say, well, no, the Fed can print money all day long and the Congress can spend money all day long, but don't call it stimulus. It's not going to have any stimulative effect. We're way past the Keynesian multiplier, which is now below 1, meaning if you borrow $1 and spend $1, you don't even get $1's worth of GDP. You get some numbers, 70, 80 cents. Forget about the multiplier. It's actually now, a divider or something that reduces GDP. Well, you don't get the GDP for the borrowing. And same thing with monetary policy, because unlike Milton Friedman, the monetarists, the neo-Keynesians, the Austrians, and everyone else, money printing has nothing to do with inflation. And they seem to, well, I don't know if they ever knew it, so I can't say they forgot it. So all the money printing and all the deficit spending will not stimulate the economy. And that's true anyway, but gold is signaling that. Look, all markets try to be forward-leaning. Some do it more successfully than others, more accurately than others, but they try. I would say that, yeah, people say, the stock market is an efficient discounting mechanism for future events, for what they see in the future. And yeah, they look into the future. Here's the forecast. They pick out a discount factor. They present value it and say, here's where stocks should be today, based on where things are going to be, 6 months or a year from now. And that's what they do sort of mathematically and analytically, except they're always wrong about the forecast. You got to get the forecast right if the discounting process is going to mean anything. So markets go through the process, but they always get the future wrong. They're not very good at predictive analytics. So this creates what I call the gap between the perception and the reality. Reality always wins, but not right away. Sometimes it takes a while. Gold, on the other hand, has very high predictive analytic value, number one. Number two, it's more forward-looking. So gold's kind of telling you where things are going to be maybe a year to 18 months from now instead of 6 months from now. And so, so gold is signaling that monetary and fiscal policy will fail and something else will be tried. And that ultimately will result in a much higher price for gold. So gold's just saying, well, let's do it now. Look, I've got gold at $15,000 an ounce by 2025. If I'm wrong about that, it'll be sooner and higher. But that's well, I consider that a conservative forecast, and we can maybe take a few minutes to go into the analytics behind that. As I've said before, you've heard me say I don't just throw numbers out there to get attention. I don't really care. I do care about getting the analysis right. And there's a number of different techniques, and what's interesting is they all point in the same direction. So it's got to go to 3,000 before it gets to 15,000. It's got to go to 5,000 before it gets to 15,000. So that's my kind of long range forecast. But it could go down tomorrow, and I'm like, I don't get depressed when it goes down. I don't get euphoric when it goes up. I know where it's going in the long run. That's the important thing for if you're trying to preserve wealth and make money. Nothing wrong with making money. I'm all for it. But sometimes preserving wealth, and risk aversion is a higher priority than just making a lot of money in the short run. But either way, gold will serve that purpose and and preserve wealth over that time period. Could it go down tomorrow? I guess, yeah. But all the vectors are pointing up very strongly. And I'll give you a concrete example. There are three things that drive the price of gold fundamentally. One you've already mentioned, which is real interest rates. The lower the real interest rate, the higher the price of gold. Number two, supply and demand. You learn it in your first 3 days in economics, but it still works. And then number three is geopolitical risk. Call it risk off or fear factor, whatever you want to call it, but I think of it in geopolitical space. Those three vectors don't all have to point in the same direction. You could have a situation where geopolitical risk is high, pointing to a higher gold price, but real interest rates are really high, and that would point to a lower gold price, et cetera. But right now, all three of them are flashing green or maybe flashing gold. The real rates are coming down. They're still high, by the way. When I always have to just roll my eyes when really smart people, Dan Isaacson, Bill Gross, Jeff Gundlach, and I admire them all, and I follow them all. But they've all been carried out feet first on this bond bubble thing, the greatest bond bubble in history, and short bonds, and the interest rates have nowhere to go but up. They're just failing to distinguish between nominal rates and real rates. Nominal rates are low. Real rates are not low. When I say low, I mean show me negative 4%. That's a low real rate. Yeah, you can pick your notes or your bills or whatever, but I usually use the 10-year note rate, 10-year treasury, because it's a good proxy for building, construction, long-term investment. People don't borrow overnight to build a building. They borrow for 7 years if they can, et cetera. So to me, that's my proxy for sort of economic growth and inflation forecasting. That's it's about 70 basis points today, et cetera. But inflation is, 1.5, take your index. So that puts the real rate, maybe negative 25, negative 50 basis points. Well, thank you very much. But, I remind people in 1980, I borrowed money at 13%, but inflation was 15%. And my borrowings were tax deductible, and the tax rate, I lived in New York City at the time, was 50%. So my real after-tax rate was about -7. That's a low real rate. So the point is, we have a long way to go. And it doesn't matter, people are interested in whether the Fed's going to pursue a negative interest rate policy, take the target rate on Fed funds below zero. Legally, they could. It's already been done in Europe and Switzerland, Japan, a few other places. I don't necessarily forecast that. I don't think the Fed necessarily wants to go there, but you can have negative yield to maturity on a 10-year note. Just whenever the premium is greater than the present value of the coupons, it's a negative yield to maturity. So you can get there. You can get deeply negative rates in secondary market trading, regardless of what the Fed does, and that will happen. And so, in the DV01, dollar value of 1 basis point is higher as the absolute level of rates gets lower. That's just, duration, just bond math 101. So we're going to have huge capital gains in 10-year notes as the yield to maturity goes, towards negative 1%. But that's going to be an enormous boost for gold. And we're not even there yet. We're seeing kind of a spike in gold prices when real rates are still, relatively high. They're only mildly negative. I was declarative when I said printing money does not cause inflation, and it doesn't. Again, I'll just use the last 12 years as Exhibit A. We should probably relate to the viewers what does cause inflation. And the answer is velocity, the turnover of money, the lending and the spending. But the problem is velocity is a psychological phenomenon. The Fed can stick the landing on money supply. They can get it down to a couple of decimal places if they want. But if you want to control velocity, which is the key, that's psychological. So what you have to do is change the psychology. Well, what is the psychology right now? It's deflationary. The savings rate in May was 33%. It had been going up. It kind of made its way like from 4% to 7%, but then it spikes to 33%. Well, savings is a good thing. You can drive an economy if you can convert savings into investment. And furthermore, if the investment is productive, unlike what China's doing. But we got some infrastructure or some other projects, R&D that would be productive. That can drive an economy. You don't have to drive an economy on consumption. You can drive an economy on productive investment. But the problem is twofold. Number one, it has a much longer time frame. That's a 5-7 year time frame. And it comes, in the short run at least, at the expense of consumption. Our economy is driven 70% by consumption. If you substitute savings for consumption, you're killing velocity. Because if I put my money in the bank and leave it there, the velocity is zero. And I remind people, $5 trillion or $6 trillion times zero is zero. You can print all the money you want, but if you don't have velocity, you don't have an economy. And so the question is, how do you change the psychology? How do you get and by the way, it makes sense to say, if you're unemployed, you better be saving because you're maybe lucky if you can pay the rent. But even people who are working or still have their jobs, they're worried, maybe I'm next. Maybe they fired the guy down the hall, but maybe I'm next, and maybe I better save more just in case, and so forth. So, and that's not a bad thing. I'm not saying that doesn't make sense. That makes a lot of sense, but understand what it means. It's deflationary. It reduces velocity. It offsets the increase in the money supply, and it's very hard to get out of. I mean, Keynes called it a liquidity trap, and he was right. That's what it is. So how do you change the psychology? Well, you need something big. You need something dramatic that's going to get people to say, wait a second, what's going on here? Well, one of them would be a $5,000 price for gold. The supply chain breakdown is causing a lot of the inflation we see. And everyone's like, wait a second, why are you talking about deflation? That's coming next. People are not ready for it. I know the inflation's here. I buy gasoline. I shop in the grocery store. I get it. It's persistent. It's not transitory. I understand all that. But inflation has two major sources. One is the supply side, which is called cost push inflation. So that's energy price shocks, fertilizer shortages, strategic metal shortages, component suppliers who can't deliver stuff to factories in Germany and they're shutting down, et cetera. The other cause is from the demand side, and that's called demand pull inflation. Basically, it's psychological. Consumers pull demand forward. They're like, hey, I was thinking of buying a refrigerator. I better buy it today because the price is going to go up in 6 months.
We will now bring you clips from the interview. Please watch, share, and like this video. Also, ensure you subscribe to the channel, turn on post notifications, and share your thoughts about the video in the comments section below. Thanks and enjoy the video. The renowned economist Jim Rickards continued her speech as follows.
In the 70s, we had both. It started with cost push with the Arab oil embargo, but it ended up demand pull. I was starting my career at the time. Your boss would just give you a raise. You didn't even have to ask. Inflation was going up so fast. Like, I better give this guy a raise. Like, here's another, $30,000 or whatever, because people would quit, and that sort of spun out of control until Volcker squashed it all. Right now, we do not have demand pull inflation. We do have cost push inflation. The difference is hugely important because cost push inflation from the supply side, it's real, prices go up, but it's self-negating. The old saying that, the cure for higher oil prices is higher oil prices, because when they get too high, people stop driving. They shut down various activities. By the way, if you're unemployed, you're not buying any gasoline because you're not going anywhere. I mean, that's kind of a nasty way of putting it, but that's how the cost push inflation tips into a recession and then prices come down. And we saw that in 1974. You had Jerry Ford and Alan Greenspan walking around with they had these win buttons, WIN, which stood for whip inflation now, except we had a recession and prices collapsed. Now, it came back by 77 for a lot of reasons, but right now we don't have demand pull, we have cost push. It will go away when this economy goes into recession. And then we're going to be talking about disinflation and deflation, which are, kind of close cousins. And the Fed's going to be out on a limb as usual, raising rates in the face of a recession and a price collapse. I don't know what the recession is a cure for. It's coming. I mean, the recession is coming, and Jay Powell said this. I mean, Jay Powell gave two speeches, August 26th, Jackson Hole, and September 21st at the press conference after the FOMC meeting that day. And the September 21st speech was almost like, well, just in case you weren't listening to me in Jackson Hole, let me tell you again what's happening. And then Jackson Hole, he was like Nancy Pelosi. He tore up a speech and wrote a new one, like literally the day before. It was 3 or 4 pages. It was really short. He used the word pain 3 times in one paragraph. I've been following Fed news for 45 years. I've never seen the word pain ever. But he basically said the same thing. But September 21st, he was even more blunt. He said, there's going to be a recession. It's going to be bad. Unemployment is going to go up. Get it straight. These things are going to happen. And that's what it's going to take to get inflation under control. But he went on and on about how inflation was job one, because the Fed has this dual mandate, which never made sense, but it's the law. I mean, Humphrey Hawkins. The dual mandate is price stability and low unemployment. Those two things don't always go together. And sometimes you got to make trade-offs between the two. But right now, the trade-off is very easy, which is unemployment's really low. Now, I don't put much weight on it, but the Fed does. Again, put your Fed hat on. Unemployment's really low. If unemployment went from 3.5 at the moment, if it went to 4.5, 4.9, is that the end of the world? Well, that was considered pretty low in 2013 when they were doing QE4 or whatever. So they're willing to do that. And they also think the recession, if it comes, will be mild, but those two things together will get inflation under control.
The renowned economist Jim Rickards continued her speech as follows. In the statement from Powell, indicated he didn't express that. Their focus is on the core PCE, the Personal Consumption Expenditure Price Index, core, meaning excluding food and energy, and everyone's like, why would you exclude food and energy? Once again, I'm not here to argue about it. That's their approach. They aim to achieve a 2% core PCE annually. Powell didn't mention that we're going to increase rates until core PCE is 2%. He didn't say that. What he stated was that we'll raise rates until it has a constraining effect on inflation, and inflation will naturally decrease because rates will be sufficiently high to prompt that, at which point we, the Federal Reserve, will pause. Then you ask, well, when will you lower rates? He was like, the pause could last a year. So you're talking. TW. Let go of this Fed policy change nonsense. You're talking about 2024 before they reduce rates. It's similar to what I recall from Vietnam, the old saying, we had to devastate the village to preserve it. We have to damage the economy to rescue it. This is the most recent in a long series of Federal Reserve missteps since 1913. It seems to be their specialty, but that's what they're doing. And on top of all that, there's an impending global liquidity crisis, a worldwide financial crisis that differs from a recession. It's a financial panic, and recessions are distinct events. They can occur independently. In 1998, we had a financial panic, but there was no recession. In 1990, we had a recession, but there was no financial panic. In 2008, we had both. They can coincide. It appears they might be coinciding again. This is evident in inverted yield curves. Major dealers are competing in auctions for treasury bills. The Fed will provide you with treasury bills with a single phone call. All you have to do is contact the Fed and conduct a reverse repo. They'll provide you with some treasury bills. However, banks are bidding in auctions for treasury bills that yield a maturity lower than what the Fed will provide with a phone call. Why would they do that? The explanation is that the Fed bills cannot be rehypothecated. They cannot be used as collateral. However, the auctioned bills can. This indicates there's a collateral shortage. This implies reducing balance sheets, financial distress. And we also observe it not only in the Treasury yield curve, which is inverted from 6 months to 10 years at present, but also in the Eurodollar futures curve, which is even more concerning. It's not unprecedented, but it is rare, and it's not a good sign. Nevertheless, the Fed persists in raising rates despite this extremely unfavorable data. So, I anticipate a significant recession in the US, and the global outlook is fairly grim. Moreover, there's the possibility of a global financial liquidity crisis worse than 2008. If all I've said is accurate, which I believe it is, or I wouldn't be stating it, they could, at the very least, take a break now or even reduce rates. But if we're on the brink of a global liquidity crisis, as indicated by the Eurodollar futures curve and the Treasury yield curve, and negative swap spreads and Treasury bill auctions with a yield at maturity below what the Fed will provide with a phone call. I mean, all these developments are taking place. That's hard data, and it's a very, very concerning sign. Less evident in 2008, incidentally, prior to the Lehman Brothers collapse. So, with the economy naturally entering a recession, along with the brewing global liquidity crisis, why on earth is the Fed raising rates at all? That's unsustainable. So I foresee a more severe recession. That's one aspect, combined with Fed tightening, interest rate increases, balance sheet reductions, and so on. That's one whole dimension, and I wouldn't place much weight on a low unemployment rate. It disregards the labor force participation rate, which is abysmal. You know, it's around 62% compared to 70% in the year 2000. However, unemployment is a lagging indicator. Unemployment rises after a recession begins. Employers are very reluctant to lay off employees. You have to pay severance. Recruiting and rehiring them and providing training is costly. Employers typically wait until the recession has already commenced, and they say, "Oh, well, I have to lay off some people." So it's not a leading indicator, it's a lagging one.
Don't forget to like our video and subscribe for our channel.
Disinflation, definitionally, but maybe even deflation is the opposite, at least for the time being. Inflation is the end game. It has to be, because there's no way out from under the debt. But right now, and people are still worried about inflation. Prices are still going up. I put gas in my car just like everyone else, so I'm well aware of it, eggs, bacon, et cetera. But inflation has been coming down steadily since June of 2022. So about 7 months in a row, 8 months in a row. It peaked then. We all know what gas prices were doing and so forth. But the reason is kind of interesting. And inflation, nominally, prices are going up. Okay, so that's inflation. But it can come from two sources that are opposite. One is from supply side shocks, supply chain disruption. We saw that in 1973 with the Arab oil embargo over the Arab-Israeli war at the time, the price of oil quadrupled, etc. That was a supply shock. The thing about supply side inflation is it's self-negating. It burns itself out. So, the old saying, and it's true, the cure for high oil prices is high oil prices. In other words, when things get too expensive because of supply disruption, people can't afford them, businesses close, you get layoffs, you go into recession, and prices come down pretty quickly after that. The other source of inflation is from the demand side, and this is a completely different dynamic. We saw this in the late 70s, where prices are going up, but people have some bargaining power, so unions are on strike, they're getting higher wages. I worked at Citibank in the late 70s, early 80s. They used to give us raises without asking. They just say, here's another $20,000, because they knew that the cost of living was going up, and we would all change jobs if they didn't pay us more. So, but that feeds on itself. So the supply side disruption tends to snuff itself out. The demand side inflation tends to feed on itself. It gets out of control. And then we saw what Paul Volcker did with interest rates in 1981, where he took them to 20%. He caused a recession in terms of tight monetary policy to snuff out the inflation. But otherwise, if you don't do that, that just runs away. Now, the inflation we saw in 2022, late 2021, 2022, it was real. It wasn't transitory the way Jay Powell said. And, the price of gasoline doubled, more than doubled, and all the other complaints you hear, the filling up your Ford F-150 pickup truck went from $70 to $140, which for a lot of people that meant they couldn't eat or couldn't, go out. It was killing demand in, entertainment, shopping, retail, a lot of other things, which again tends to snuff it out. So that has happened to a great extent. Starting in June 2022, that was the peak, and this inflation has been coming down. Now, it's still too high. The Fed's not done. We're going to see at least one more interest rate hike, maybe, but they're going to leave one more on the table. We'll see what happens in June. I'm not forecasting June, but I would not rule out another interest rate hike in June after the May hike. So, because Jay Powell's thinking, how many times do I have to say this? He's given 9 speeches since August 2022, August 26th at the Jackson Hole, then September FOMC meeting, November FOMC meeting, end of November, a speech at the Brookings Institution, December FOMC, congressional testimony, et cetera. And every time he said the same thing. Inflation is job one. We've got to get unemployment up. Believe it or not, we're going to have a recession and unemployment's going to go up. Sorry about that, but we've got to get inflation under control. And until we do, what's under control mean? Well, it's 2%. That's their goal. Well, it's come down from 9 to 5. Nice job, but 5's still a far cry from 2, and it gets harder as you go along. And they're searching for what they call the terminal rate. So the terminal rate, no one knows what the number is. I don't know because Jay Powell doesn't know, but the terminal rate by definition it's a rate that's high enough that it brings inflation down on its own without further rate hikes. Because so far they've been raising rates and inflation's been coming down. Okay, that makes sense. And they can keep raising rates and it'll come down more. But is there a level where, we're there, now we can sit tight, the famous pause, and inflation will keep coming down. Now you don't know because it's not a controlled experiment. You can't do it twice. But they're getting close. So whether it's 5.25, 5.5 remains to be seen. But that's the terminal rate. But then Wall Street came up with this narrative. Oh yeah, as soon as they're done hiking rates, they're going to cut them. This is the famous pivot we've been hearing about for over a year at this point. No, as far as they're concerned, forget rate cuts in 2023. Maybe mid-2024, we'll get back to you on that. But there's one wild card in the deck, which is that's the Fed's plan. So I just gave you the Fed's game plan. It's not, you don't need a crystal ball. They tell you what they're going to do. All you have to do is listen, although a lot of people don't. Wall Street makes up their own version of that. But the idea of rate cuts following hitting the terminal rate is, well, rate cuts go down, so dividends look higher, so buy stocks. Wall Street is always buy stocks. That's always the punchline. But they might cut rates late in the year, not because it's their plan, not because they want to, but we could be in a very severe recession. And that, at which point, because the Fed's always late, they're always following the market. They never lead the market. If they've already raised it, let's say they may already be at the terminal rate, not know it. And so if they keep raising, which I expect they will, they may throw this economy into a very severe recession, at which point they may have to cut rates, not because it's in the playbook, but because, unemployment goes up to 7%. And, but that gets back to the first question, Constantine, which is what's next? Disinflation may be deflation. The answer is diversification. Everyone goes, oh, we know that, diversification. But they know the term, but they actually don't know what diversification is. And I'll give you an example. I run into people all the time. They go, well, Jim, I'm fully diversified. I have 50 stocks in 10 different sectors: telecommunications, semiconductors, consumer non-durables, metals and mining. And I go, you're not diversified. You may have 50 stocks, but you're in one asset class called stocks or equities. And they're all going to go up together, or they're all going to go down together. And the more stressful the condition, the more reason you have to be concerned about it, the higher the correlation. On any given day, some stocks go up and stocks go down. But when you dial the stress meter up, they all tend to move together. So I don't care about your 50 stocks, your 10 sectors, that's not diversified. So what does real diversification look like? Have a sleeve of equities if you want, that's fine. I would say I look hard at oil, natural gas, natural resources, agriculture. Again, kind of equities that have hard assets behind them that will do well in inflationary times or even in recessionary times, because you need all those things no matter what. Then a slice of real estate. I wouldn't be in commercial real estate, but residential real estate, income producing real estate, farms, etc. That's good. I have a big slug of cash. And people go, well, cash doesn't have any yield. Well, lately the yields, you can get 2-3%, in like a CD. But even in a simple savings account, it is quite low. It's kind of less than 1%. But people don't understand the value of cash in a couple of respects. Number one, in a deflationary environment, we're not there yet, but we could hit that if the recession gets bad enough. Cash could be your best performing asset. It doesn't go up in nominal terms, but it goes up in real terms. If you have 2% deflation, your cash is worth 2% more in terms of purchasing power. But the real value of cash is optionality. And this is not well understood. I shared an office with Myron Scholes for 6 years, so I see options under the pillow, so to speak. But if you're the one with cash, when things, first of all, it'll definitely preserve wealth. So if things are falling all around you, your cash will be what it's worth, unless you're in Silicon Valley Bank. It's a separate issue. But although they got bailed out. But so it'll preserve wealth, even if it's not a high performer. It'll do very well in deflation. But the real benefit is when everything else is falling apart, you're the one who can go shopping. So it's kind of an at-the-money call option on every asset class in the world. Everyone's selling everything in a panic. You can bide your time, watch it go down, look for a bottom, and then say, okay, now I'll buy these things down 30% or 40% or 50% from where they were. Some alternatives. I have a number of investments in private equity and venture type situations, and yeah, they're risky and they're not liquid. But some of them will do very well. Some of them have done well, so that's nice. And then a slice of gold. And I recommend 10%. Because people, they put words in your mouth and go, Jim Rickards says, sell everything and buy gold. I've never said that, not a good strategy. But 10%, yeah.
Hey guys, welcome back to Nifty Invest. In this video, Jim Rickards discusses the relationship between interest rates and the business cycle and the different indicators that suggest an economic downturn may be on the horizon. He notes that interest rates are a lagging indicator, and that business owners, entrepreneurs, and medium-sized businesses are often the first to notice when a recession is imminent. He also points out that while the stock market is predicting a soft landing, the bond market is signaling that a recession is coming, and that the inversion of yield curves is a particularly worrisome indicator. Don't forget to like and subscribe if you enjoy the content we do here on this channel. Let's get right into the video.
The interest rates are a lagging indicator. Everyone's like, well, how could interest rates be going up if we're in a recession? The answer is, as you get closer to recession, who figures it out first? Well, the Fed figures it out last. They're usually the last to know. Wall Street is second last to know. The people who figure it out first are actual business people, entrepreneurs, restaurant owners, dry cleaners, taxi drivers, or even medium-sized businesses. They see it. If you're in the trucking business, it's real time. If inventories are sky high and new orders are being slashed, you're not moving anything by truck. So there are certain businesses that are concurrent. But the stock market is saying, yeah, the Fed's raising rates, inflation is coming down, but we think they're already at the terminal rate. But not only that, we think they're going to get the memo that the Fed will figure that out before they get to 5.25, before they raise rates in May, maybe even March. Maybe they're done. And because of a recession, this is the soft landing Goldilocks scenario, where the market's right, the Fed's wrong, but the Fed will realize that the market's actually right and cut rates, and if you're going to cut rates, buy stocks. That's like Wall Street always ends every analysis with buy stocks. If you listen to Michael Burry, Jeremy Grantham, Charlie Munger, these people have been around and they run, hundreds of billions, and they're saying the same thing. So Jeremy Grantham actually did do a 100-year time series and looked at bubbles all over the world, 1929 US, 1989 Japan, 2000 dot-com stocks, and many others. And he said he's never seen anything like it. It's a triple greatest bubble of all time times 3, in the sense that it's real estate, stocks, and other asset classes. So yeah, I do. That is my view, but it's shared by a number of other analysts. 1929, everyone's like, yeah, October, I think 18th or 19th. It was late October 1929. The stock market fell 22% in 2 days. It wasn't one day. It was like 12% one day, 11% the next day. So 23% over 2 days. But that wasn't the crash. That was the beginning of the crash. This Dow Jones fell 82% from top to bottom. Now, it took 3 years. It bottomed in June 1932. Started in October 1929, so not quite 3 years. But that fell 82%. And that happened. So yeah, we're down, NASDAQ's down, bounced back a little bit in recent days, down close to 30%, down, the S&P down over 20%. We're in bear market territory, but that's just the beginning. That's not what a full bear market, market adjustment looks like in the face of the kind of recession that I expect.
Jim Rickards explains that interest rates are a lagging indicator, and that people like to question how they could go up if we're in a recession. However, as we get closer to a recession, business people like entrepreneurs, restaurant owners, and taxi drivers are the ones who figure it out first, not the Federal Reserve or Wall Street. The stock market might say that the Federal Reserve is raising rates and inflation is coming down, but it might not be the case.
The bond market is telling a completely different story, by the way, and this is a little more esoteric, but if you look at yield curves, look at the Treasury yield curve, Euro-dollar futures yield curve, German bunds, they're all inverted. They're all inverted. Now, inversions happen, just meaning the longer-term rate is lower than the short-term rate. Now, this is in the Treasury yield curve. They're inverted from 1 month to 20 years. It's not like, people talk 2s and 5s and 5s and 10s. 1 month, a 1 month bill is yielding more than a 20-year note. Okay, that's inverted across the entire yield curve. The Euro-dollar futures, same thing. The inversion kicks in. It doesn't kick in immediately because the Fed does control very short-term rates and they're raising them, but the kink kicks in like in March 2023, which isn't that far away. And bunds have never been inverted. They are now. Even the inversions that have happened in the past, which are rare, have not been as steeply inverted as they are now. We're seeing something globally we've never seen before. And it is the best single indicator of a recession. The last time we saw anything like this was in 2007, just ahead of the 2008 financial catastrophe. So the stock market's saying it's all good, Goldilocks, soft landing, Fed's going to get the memo, they're going to cut rates, the pivot, and buy stocks. The bond market is saying no. This is bad and it's going to get worse, and it's actually too late for the Fed to do anything about it. But as far as banking and credit is concerned, what happens is if you're a business person and you see business heading down, fewer customers, whatever, you go out and borrow all you can. You're like, hey, there's a really bad recession coming. If I got lines of credit, I'm going to use them up now. I don't want my bank changing the terms. I don't want material adverse average change clauses kicking in. Instead, I'm going to borrow everything I can. And that creates a demand for funds and interest rates go up. And then the recession hits and the bankers go, what's going on, credit losses start going up, and then they just turn off the spigots and they raise standards, they stop doing loans, and then interest rates will start to come down. But interest rates peak after the recession has already begun. So interest rates may not have peaked yet. I mean, even the treasury market. So that's not unusual.
Jim Rickards believes that we are in a triple greatest bubble of all time that includes real estate, stocks, and other asset classes. The bond market is telling a completely different story and indicating that we might be headed for a recession. This is the best single indicator of a recession, and the last time we saw anything like this was 2007, just ahead of the 2008 financial catastrophe. The stock market believes that it's a Goldilocks soft landing, but the bond market is saying that it's going to get worse, and it's actually too late for the Fed to do anything about it.
So stock market's telling us Goldilocks, bond market's telling us, here comes, Hurricane Mitch or whatever. And then there's what I call the reality. The standard definition of a recession is 2 consecutive quarters of declining GDP. There are a few more bells and whistles having to do with unemployment and a few other things, but that's the rule of thumb. So based on that, and based on the best available estimate for a second quarter, likely to be accurate, we're in a recession today. Now, it's not severe, but that's like saying I'm in bed with pneumonia, but I'm not dying. Well, okay, but we're in a recession right now. The Fed's doing what they're doing, right or wrong. Okay, they're doing what they're doing. The market has their own interpretation. I agree with the market, certainly the bond market, that the Fed has probably over-tightened. That means they're going to make it worse. They're going to make the recession even worse. In other words, if the Fed cuts rates, which they may, the pivot may be real. It's not because they engineered a soft landing and Goldilocks and everything. Oh, that's just right. It's because they screwed up as usual, as they've been doing since 1913. And we've seen this movie before. This is exactly what happened in 2018. I mean, the Fed was tightening into that collapse. The Fed tightened on December 16th, 2018, only like 8 days before the Christmas Eve massacre. And after most of the 20% collapse had already happened, they tightened one last time. So what it shows you is that when the Fed's on a mission, they actually don't care about the stock market, this whole, Bernanke put and Greenspan put and all that. That's not how it works. They don't care that much about the stock market level. Here's what they do care about. They care about disorderly markets.
What do you think about this video? Comment down below. Don't forget to like and subscribe. This is Nifty Invest. We'll see you in the next video.
What do you think is a rational allocation right now for somebody who's at first and foremost trying not to get destroyed this year?
Yeah, and to be clear, I don't give personal financial advice, but at a macro level, I'm happy to talk about
Absolutely. None of this is personal financial advice. Definitely talk with an advisor, and I'm going to make that plug at the end here too.
Portfolio might look like. The first thing you say, diversification, the math and the science behind diversification and why it's a good strategy is very clear. There's not much debate about that. The problem is people don't understand what diversification means. They think if they have 50 stocks in 10 sectors, semiconductors, consumer non-durables, or whatever, they're diversified. And what I say to them is, you may have 50 stocks, but that's one asset class. You're in stocks. And in stressful situations, they become highly correlated. So you're not getting the benefit of diversification. You think you are, but you're not. So what does a diversified portfolio look like? Well, I have a slice of stocks. I'm not anti-stock market, but you got to pick the sectors and the stocks that will perform well, even in the kind of conditions we're talking about. And I would go back to energy, natural resources, agriculture. So, a Marathon, ExxonMobil, Chevron, ADM, Cargill, mining companies, and not just gold, yeah, but I recently invested in a lithium mine. I think the climate alarmists, I think the Green New Deal, I call it the Green New Scam. This is a scam, but it doesn't mean it doesn't have legs, whether you like it or not. The fact is, it's going to go on. So the lithium's in short supply, graphite, et cetera. So there is a portfolio you can have, which is natural resource oriented, that will do well, even in the kind of tough environment we're talking about. Slug of cash, absolutely, maybe as much as 30%. I like treasury notes. 10-year Treasury notes, but seasoned to taste. If they're a little too volatile, look at 5-year notes, 2-year notes. They're going to come down a lot. Not right away, not tomorrow morning, but sooner than later because of everything we discussed, which is a recession and interest rates will follow. They're a lagging indicator, but that'll happen. Gold, I always recommend a 10% slice.
Hey, Jim, real quick before we move on from bonds there. So I've talked to a number of analysts and investors, on this program recently who have echoed what you just said there about bonds. And, there are three really good reasons to hold them right now. One is just safety, right? This is a time to prioritize safety. Two, they're paying a lot more than they used to pay. So you're getting paid to sit in safety, which is nice. But then they have that option value, right? Where if the Fed does pivot and rates come down, yields come down, the actual underlying price of the bond would go up. Right. And so a number of these guys have said, the bonds, particularly the sovereign bonds, especially the U.S. Treasuries, they're looking the best they've seen in a long while. And relatively recently, some have said it's like the best I've seen in my career. So I'm just curious, do you find that compelling for the moment in time we're in here?
Absolutely. There's hate to get too deep in the weeds in terms of bond math, but there's something called a DV01. DV01 is the dollar value of 1 basis point. What that means is, obviously basic bond math, interest rates come down, the price of the bond goes up. They're just inverse. It's a little counterintuitive, but rates come down, the bond goes up. The question is how much? And the lower the interest rate, the more the price of the bond goes up for every basis point drop in rates. So in other words, if you go from 9% to 8%, you'll have a nice capital gain on your bond. But if you go from 3% to 2%, it's still a 1% drop, but you're going to have a much bigger capital gain. In each instance, it's a 1% drop in rates, but the amount of capital gain on the bond is much higher, as the DV01 is higher when the rates are lower. Again, it's all counterintuitive.
But it's sort of like a Richter scale. Each new increment is a much higher magnitude.
The lower the rate, the greater the capital gain on each basis point drop in yields. That's the basic. So yeah, when you go from 3% to 2%, that's a home run in terms of capital gains. So you get the yield, you get the safety, you get the liquidity, and if you feel like selling it, you got a nice fat capital gain.
Okay, great. Thanks. Sorry to interrupt, but I just thought that was a really important point to underscore.
Yeah, I agree with the analysts who are saying that. Absolutely.
Okay, great. So on to gold, you were saying 10%-ish is
10%, but based on what we were talking about, I would get silver dollars, American silver eagles. A monster box, bit of jargon. Monster box comes from the U.S. Mint. It's treasury green, nice shade of green. It comes with a compression strap. I recommend don't open it, unless do not break except in case of fire. But inside are 500 1-ounce American silver eagles. That's a lot. They'll feed your family for probably a year, and they run, it's a market price, but be around $10,000-$12,000 for a monster box. But to me, it's like battery and flashlights. Just have one, stick it in a safe place.
All right, great. And I'm curious, do you have any particular thoughts on silver versus gold right now in your 2023 outlook?
Yeah, I like them both. And, I talk about gold a lot because it's a form of money, and I do the monetary analysis. I do invest in gold mines, but I don't hold myself out as a geologist, but I do think about it from a monetary perspective. And then people always say, Jim, what about silver? What about silver? I'm like, look, if gold soars the way I expect, silver's along for the ride. There's not going to be a world of $3,000 gold and $20 silver. That world doesn't exist. If gold's at 3,000, silver's going to be pushing 100. So without giving an exact forecast, silver will be along for the ride. Silver's a little more difficult to analyze because it has industrial applications. Gold really doesn't. Gold's not good for anything except money, but it's the best form of money. Silver is used in a lot of applications. So if you have a recession, it's perhaps the case that the monetary value is going up, but the industrial input value is going down. So it's a little bit more of a mixed bag, but silver is going to do fine. And I do think it's extremely practical because in a world of CBDCs, silver will be a form of spending money. Gold, even the 8-gram coin I mentioned, the quarter-ounce American Gold Eagle, still $500. It's like pulling a $500 bill out of your wallet. It's a lot for groceries.
Right. So think of the gold more sort of the store of value, and silver more as the currency.
Yeah, but the quarter ounce, maybe 10 of them gets you a new car or something. So
Yeah, exactly. Yeah, for bigger purchases.
Right.
Yeah. Okay, great. So that's gold. I know in the past you've said, hey, real estate, private equity, farmland, et cetera. Those are all things to consider as well.
Yeah, I think income producing real estate. I wouldn't get into commercial real estate, residential. The prices are, home prices are coming down a little more in some markets than others. But if it's income producing and it's solid and it's in a place like, someplace people want to be, like Austin or Phoenix or whatever. I mean, I know there's markets down a little bit right now, but it's like buying a 10-year bond. It's got steady monthly income and or certainly farmland. But income producing real estate, not commercial office buildings, should be a part of a diversified portfolio. Yes.
All right, great. I got one last topic I want to talk about with you. Before I do anything else, just sort of on. Actually, let me ask this. So we talked there about sort of diversification, largely with the eye towards sort of making it through what's coming here. Are there any areas that you potentially think are like, hey, given the events that we see coming, yes, while they're a little scary, there's some opportunity maybe to really, if you have some speculative capital, this could be a place that you think could pop really well?
Yeah, I mean, I like private equity, and it's, you got accredited investor issues and finding good deals and good promoters and good management. But there's some some good deals in the mining sector. I like that would be one. I mean, we haven't really talked about the important things going on, but we'll maybe do that in another interview. If one of our supply chains or one of another country's supply chains that we rely on collapse, it could cause an unprecedented economic super collapse on a global scale. And that's how we could end up with this $85 trillion economic super collapse I'm predicting. $85 trillion being the value of the global economy. Because remember, our current supply chain is interconnected on a global scale. And if there is a single point of failure, the whole system is going to come collapsing down. Farming, banking, healthcare, oil and gas, tech, and so on. This isn't the first time I've warned Americans about this before. On May 11th, 2020, I told my followers, the economy will not return to normal for years. There are serious constraints on supply. I issued another warning about my research on November 24th, 2021. The supply chain difficulties will certainly grow worse. The remedies will take years and sometimes decades to implement. And yet another in 2022. Don't believe the happy talk about a temporary supply chain crisis. I'll say that again. The crisis will last for years with predictable negative effects on economic growth. But now things are even worse than ever before. And I fear this economic super collapse could hit American soil in the next 6 to 12 months. So this may be my last and final warning before it's too late. It's why I'm warning people around me it's only a matter of time before the world economy comes crashing down. Because when you talk about risk of catastrophic collapse, the risk increases with the size of scale. Look, whether you decide to listen to me today about how to prepare, whether or not you decide to get access to the information in this envelope, that's up to you. It's a free country. You can do what you want. You can even pretend you never heard me tell you any of this. But just know, Joe Biden certainly isn't going to come to your rescue. Take a look at this 9-second clip from the president.
When do you think things will get back to normal?
When do I think things will get back to normal? But my hope is by this time next year, we're going to be back to normal.
That clip was taken over 18 months ago. It's up to you what you believe, but I can't bury my head in the sand and ignore all the facts, and the facts couldn't be more clear. So in just a moment, I'm going to explain how you can get access to this information inside the envelope as part of my super collapse preparation package. And I'm going to talk about what to do to protect and even grow your wealth. Look, please understand, it brings me no joy to say this, and I hope the worst of what I'm warning of never comes to pass. But there's only one potential solution to this crisis, and it's going to take years. Recently, I spoke to a very well-informed CEO of a major corporation, and I asked him point blank, I said, your company must be looking ahead of some possible solution. Is there anything you can share? Well, I'm going to tell you the same thing he told me. He said, Jim, you have to understand that it took us 30 years to build these supply chains. We blew it up in 3 years, beginning in 2018, and you can't put it back together. But there is one thing we can do. It's not a quick fix, but it's our best and most sensible option. Our only way out is to build a new supply chain that eliminates the bad actors. We can't continue to allow our enemies like China or Russia or Iran to threaten consumers here on American soil. As the Wall Street Journal wrote, Russia's lengthening war with Ukraine will lead to a near doubling of inflation rates in rich countries. It's why the New York Times wrote, "This is what happens when globalization breaks down." And why Barron's wrote, "Secure U.S. supply chains with allies and move out of China." Unfortunately, this solution could take years or even a decade to fully implement. And that CEO told me it will take at least 10 years to reconstruct the supply chains if we don't want to do it with China and globalization. But whether you realize it or not, that's the bet we're making as a nation. It's happening now. And when the dust settles, we're either going to have rolled out this new supply chain before a worst-case scenario happens, or we're going to face whatever lies ahead from this $85 trillion economic super collapse. Now, maybe you're wondering how bad things could really get. Let me answer that question with another question. Do you remember your life at the beginning of the pandemic? Despite all of our freedoms we all hold so dear, an unelected official with the ear of the president recommended immediate lockdowns. And suddenly we heard demands like shelter in place or stay at home, backed up by the threat of arrest. Large swaths of the economy ground to a halt. Looting took over our towns and cities. Because so many businesses were shut down, people were emboldened to take to the streets. But if most Americans don't have access to enough food, water, or other necessary supplies, do you really believe our streets and our businesses won't see more violence? It's why gun sales keep hitting all-time highs as more and more Americans prepare for whatever lies ahead. And while I hope the worst of what I'm warning in my urgent new book never comes to pass, I don't suggest you rely on hope to protect yourself and your family. I'm certainly not. Here's how I'm ensuring my family's well-being. First, I would suggest stocking up on essentials, just like I've done. I have a fully finished area in the basement of one of my properties, the address of which I keep totally private. It provides me with a warehousing area for months' worth of canned foods and other non-perishable provisions. That's important. Don't stop with a 3-day supply like the CDC recommends. Make sure you have enough water, basic food, and toiletries to last at least 3 months. And keep them in a safe area where they can sit without damage or spoiling. I would also recommend buying several large capacity freezers. I already have 3 and I may continue purchasing more. If you have the means, consider installing alternate energy solutions in case of a worst-case scenario. I've already installed the largest non-commercial solar power system in New England on my property. If you can, have alternative sources of power generation on your property. I've also dug 3 wells, planted abundant gardens, and built a significant greenhouse. But whatever you decide, do recognize that none of it will matter if you're not getting accurate information about what to expect in the coming days. Like I said, to be able to make the right decisions during a crisis, you need to lean on someone. So if that's not me, you should find another well-connected person you can trust, ideally someone who's previously held a position of power in our government. But if you want to learn what's inside this envelope and see what I know, right now is your chance. See, I've gone ahead and published this information I'm holding here in this envelope inside my newest book. It has brand new proof of the unfolding situation and inside-level details on how it will play out. Urgent Preparation Report number 1. Buy this asset after securing your family's food and energy. As the economy collapses and the shelves are bare, the government will respond by printing even more money. When it does, the value of the dollar will be destroyed through inflation. But 5,000 years of history proves that one item, gold, outlasts every other currency as a form of money. And I believe that economic collapse occurring right now will send gold skyrocketing over the next 6 months. That's why I'll send you my urgent report called The Perfect Physical Gold Portfolio. Everything you need to know about buying the right kind of physical gold as part of my Super Collapse preparation package. You'll find everything you need to know about investing in gold before the price blasts through the ceiling, including, is gold safe to invest in? How much should I invest in precious metals? What metals should I buy and what should I avoid? What are the best places to buy gold and other precious metals? What are the safest ways to store gold to avoid theft or government confiscation? And much more. Plus, I'll also send you Urgent Preparation Report number 2, my Biden Bucks Protection Plan. I haven't mentioned it yet, but during my research, I came across a troubling executive order that President Biden just signed. See, every time there's an economic crisis, the government responds with massive new programs to try and control the economy and its citizens. In 2008, it was bailouts of big banks and new government agencies to regulate the financial industry. This time, it will be much worse. I've uncovered a plan for U.S. government cryptocurrency I call Biden Bucks that I believe the government will unveil during this economic collapse to control your money and manage the societal fallout. By the time this program is announced, it will be nearly impossible for everyday Americans like you to protect their wealth and keep their privacy, which is why I've created another urgent report to get you prepared ahead of time. Inside this new report, you'll get step-by-step details on what these Biden bucks are, why they'll be used during this collapse, and how to outsmart this sinister program by creating, 1, an off-the-grid fortune, secure $1.1 million in wealth inside a soda can safe. 2, saving your freedoms, have liquidity and spendable wealth without using Biden bucks. And 3, growing your personal wealth. You'll get possible investment upside as events unfold. And 4, ensuring you maintain your wealth regardless of external conditions. Building your own off-the-grid portfolio now will protect you from the government surveillance day coming during the economic super collapse. Biden bucks testing is underway. The digital dollar could be rolled out soon. Before it's too late, make sure to protect yourself and your retirement savings. You'll find everything you need in this urgent report as part of my super collapse preparation package. But that's not all, because you'll also get urgent preparation report number 3. Secure this secret off-the-grid asset. You see, I've learned of another little appreciated asset that's a liquid form of wealth. It can't be tracked or traced. It's completely legal and easy to find if you know where to look. Over time, its value has steadily grown, but very few people know anything about its investment potential. You're about to be one of the few. I believe you must include this secret asset in any off-the-grid portfolio.